and kick things off. Good afternoon and welcome everybody to the American Family Insurance Dream Bank, where we believe in the transformative power of dreams. My name is Andy Frisky. I am a senior dream curator here at Dream Bank, and on behalf of our entire team, so stoked to have you all with us here today. As we get started, we always like to poll our audience and see where people are tuning in from. So if you're comfortable, please go ahead and do so in the chat. I know that I'm in the heart of Madison, Wisconsin. Many of our panelists are in the Dane County area as well, but we'd just love to see where people are joining us here from today. For those of you who have attended our virtual or in-person events in the past, welcome back. For those of you who are joining us for the first time, I'd love to take a few moments to introduce you to Dream Bank. So here at American Family Insurance, we believe that communities are stronger and the future is brighter when people are actively pursuing their dreams. And that's why we created Dream Bank. It's an inspirational community destination and virtual experience that is dedicated to dreamers everywhere. From our daily event series to immersive signature programming, there's something for every dreamer, and our offerings are designed to help you celebrate the dream journey, overcome obstacles, and to stay motivated. Before we go ahead and start today, this video content has been made available for informational and educational purposes only. Watching this video is not considered legal advice and does not create an attorney-client relationship with attorney Megan L.W. Jerabek, or the law firm of Briesen Roper. You should consult an attorney or any other professional on how this information applies for you. But really excited now to introduce our moderator for today's event. I'd like to welcome back to the stage Katie Powell. Katie, go ahead and take it away.
Awesome. Thanks so much, Andy. And thanks to everyone who is joining us for a discussion on how to buy and maintain your first rental property. As Andy said, my name is Katie Powell, and I'm with American Family Insurance, and I'm going to be your moderator for today's discussion. Please note, we do have a chat functionality, so if you have a question that comes up during the Q&A, feel free to throw that in the chat, and we will address that as we go along for today. So before we get into our Q&A, why don't we learn more about our panelists and our experts in each of these fields? First up, we have Jeff Mack. Jeff is the first vice president of private banking at the Park Bank, which has branch locations throughout the Madison, Wisconsin area. Next, we have Gerardo Jiminez. Gerardo is a real estate professional and a real estate investor. And Gerardo is with Sprinkman Real Estate located in the Madison, Wisconsin area. Our resident attorney for today's topic is Megan Jerabek. Megan is a shareholder and attorney at Briesen Roper, which is located in DeForest, Wisconsin. And our last panelist for today's topic is Heather Spencer. Heather is the branch sales manager at American Family Insurance located in Las Vegas. So we are going to just jump right into today's topic. I know we've got a lot of good questions. And again, our experts are ready for us. So Gerardo, we're going to start with you. What should a first-time real estate investor look for in a rental property?
Thank you for the introduction. Hello to everyone. First thing, I think a person who's looking to buy properties in an area, I always recommend start with the location. Start with a location that you feel comfortable with. Start with a location they have a good basis and understanding of what the residents are like. Then I always recommend looking for a property that's attractive to you. That's something that you think is beautiful and that you would love to own. And then I finally finished that with an income analysis. So hopefully at the point where you're shopping for a property, you have an understanding of what kind of returns you would like on that investment. So you can put all three things together. Number one being the location, number two, the look and the feel of the building, and then number three, what you can expect to get from a financial return on that investment.
Awesome. Thank you so much. Okay, Jeff, we're going to pass the next question over to you. What kind of properties are considered an investment property, and how would you get a loan on an investment property, more specifically a single family rental or a duplex?
Yeah, thank you so much. And again, I also want to just say I apologize, everyone. I thought I was getting a private room that was going to be able to give light, and the lady said that this would be a great room. And then this is what I have here. So I feel like, as my friend Gerardo said, I feel like I'm in Orange Theory, which is not what I was looking for. But again, my apologies. But yeah, to answer your question, Katie, an investment property is basically, to answer the definition of an investment property, it's a property that you're looking to get a return on. Any type of property that you are looking to get some type of return on your investment. And so from an investment property standpoint, when you're looking to buy, it could be the same thing as a single family home that you're looking to rent out. It could be a duplex that you are looking to rent out one side and live in, or it could be a duplex that you're looking to buy as just a non-owner occupant, just investment. So in units from a banking standpoint, a single family home to a 4-unit building are considered residential properties. And then 5 units and above are considered business loans or non-residential property. So those are more business loans structured around you running we think of it as you are running a business around getting a return in multifamily ownership. So to answer the question, 1 to 4 family units are considered residential, then 4 or 5 units and above are considered business loans.
Perfect, thank you. One follow-up question for both you and Gerardo is you both have mentioned already investment and return on investment. So can either one of you talk a little bit more in regards to what you mean by return of investment? Is that captured through monthly rent? Is that captured through equity within the home? If you could provide just a little bit more detail, either one of you, that'd be great.
Yeah, I'll tackle this question first, and Jeff, you can feel free to add on anything from the lending angle. So there's 2 ways for the most part to calculate what your return on investment is. One is, as you alluded to, the principal pay down. So one of the benefits of owning investment properties is that they if done properly, they self-pay or they self-manage, so the income generated from the rent goes towards paying all expenses and theoretically your lending cost. And so the 2 most common ways of measuring, your return on investment is 1, calculating how much you're paying in principal down every year and how much you're lowering that loan amount by, and then an actual cash flow to the actual buyer or the owner at that point. So if so that would be the secondary method on identifying, return on investment is the actual money that's returned on a yearly basis to the individual owner.
Yeah, I would agree and concur with everything Gerardo said. I think one of the other things is, and I think we'll go into this a little bit down the road around the conversation of, as a bank, what does the bank require an investment property to return for you? Normally, we at most banks on an investment standpoint have a qualification around a 1.2 or basically like a 20% return they want to see on paper. But again, from a buying of a 1 to 4 family unit, a lot of times it's just from a qualifying standpoint, are you able to make your payment? Because banks look at what we call it ability to repay. Do you have the ability to actually repay the loan with the income that you're getting from the property, as well as with income that you currently make, whether it be a day job or, however you live, or whatever your budget looks like.
Yeah.
That makes a lot of sense. Thank you both for that. We do have a question from the chat from Jane. And Jane is basically saying, is there a preferred time frame that you should use to determine cash flows and whether it's paying for itself over 10 years, 20 years, 30 years, and really what that looks for. So Jeff, that might be more towards you.
I can jump in. I think, Jane, the hardest thing about answering this question in a general sense is return on investment, or your timeline for your return is very subjective based on your wants, needs, what you're looking for out of that investment. I may have a return on investment trajectory of, I want to sell a property in 5 years and I want to make 10% every year. Someone else may say, Megan may say, hey, I just want a property that I want my kids to live in so I don't have to pay rent when they go to college, right? So there's different rationales behind why people buy property and how they determine investments or what their investment to look like and return for them. Yeah. There's a standard that people look at, which is kind of like a 5-year projection, saying, okay, if you get rents, you buy the property year 1, you get your rents in, you grow over time in 5 years. What does that overall return look like? But again, it's very subjective. And I would say, really look at it from the standpoint of what are you looking to buy this property for and why? And then kind of reverse engineer that number from there. hopefully that makes sense.
That's great advice. And that's a really good call out too, Jeff, in the sense that these are all very personal goals. So it's really important to understand what your comfort level is when it comes to investing, and then also what that time frame looks like for you too. You know, are you going to begin looking today, tomorrow, or 5 years from now? All of those really factor into some of these things. So thank you for the question, Jane. Again, for anyone else who has questions, feel free to throw those in the chat and we will try to address those as they come up. I do want to move on and ask Heather a question regarding some insurance. So when should a landlord contact their insurance agent to get a quote on a rental property?
Yeah, thanks, Katie. Great question. Really early on in the process, ideally, I'd say prior to or during that house hunt, an insurance agent can be really helpful by identifying exposures and potential risks that you might want to consider when you're looking to purchase a home, like a pool, for example. An agent can also help with identifying certain zones that might be harder to insure. So think flood zones, that might be a tough risk for us to insure. Out here in the West, we have wildfire areas or zones that can be really tough to insure as well. And really in this market, if you've heard that the insurance industry is going through a hard market, we are. That's really being driven by climate change. So as climate change is impacting a lot of different industries, the insurance industry is really being impacted by climate change, and it's driving a lot of damage to the properties that we insure. We pay out more in claims than what we anticipate. We have to look at different areas that we can help control those expenses. And one of the ways that insurance carriers do that is by tightening of their underwriting guidelines. So a property that was once able to be insured or eligible to be insured 2, 3, 4, 5 years ago might not be insurable today. So connecting with an insurance agent early on is always going to be key. Now, to say that property is uninsurable, that's not always the case. Many insurance agents have access to carriers that can place business with higher risk markets. But you might pay a premium for that. And again, working with professionals like Gerardo and Jeff, they might have a tougher time when it comes to that insurance piece, when we're saying, well, gosh, that insurance is going to be double or triple that amount because it's in either a higher risk zone or the characteristics of the property itself might not be insurable. So certainly early on in that process is always going to be the best time to connect with an insurance agent.
That's awesome. Really good advice. And I know you mentioned, insurance agents have other markets that they might be able to, or other carriers that they might be able to use. And often the lead time on that is even greater, right? So it's important to, just as you said, connect very soon. So that way there's time to look into different options. So that way it doesn't delay closing, delay cash flow, delay equity being built into the home. So great advice there. Okay, I want to give the next question to Megan. Megan, are there certain legal structures that landlords should consider when buying or owning real estate investments?
Yeah, hi, welcome, and thanks for hanging in there with us today. There definitely are. So when you are looking to purchase real estate, whether it's your first time or you've done it multiple times before, there's always a decision to make on how you are going to own that real estate moving forward. And generally speaking, the options are outright ownership, where you're taking title to the property yourself or with your spouse or business partners, or if you're going to own it through an entity of some kind, the most common of which being a limited liability company or an LLC. And the difference between those two is something that oftentimes people who are buying their first piece of real estate don't really think through, because they bought their home and they bought that in their own name. And so when they go to buy the duplex, they think the process is the same. They'll take title to it in their own name, just like they did with their primary residence. The difference is when you have income producing property that you're renting to third parties, your risk goes up. because you now are not living in the home yourself. You have other people living there. You're not there to monitor behavior, actions, maybe sometimes maintenance issues or things that you don't know about right away, like you would if you were residing in the residence. And so the difference in risk profile for investment real estate versus residential, personally owned real estate or your primary home real estate leads most people to want to take ownership to that investment real estate in an entity, because if you think of an LLC as a bucket or a pot, if you create the LLC and the LLC purchases the real estate, that provides risk management protection for your other assets, because if somebody slips and falls on that real estate, for example, or something happens there, they are going to sue the owner of the real estate, and the owner now is this bucket or this pot. And so if you follow the formalities that you should, and you work with lawyers to make sure everything is set up correctly, you're hopefully insulating the risk of that liability to the entity and the building itself, and not exposing your personal assets to unnecessary risk. You can certainly insure over risk, right, as well. And so if you're going to take title to that real estate in your own personal name, then one way to help with the risk is to buy additional insurance to make sure you have sufficient coverage, not only for what happens to the damage to the property if something happens, but liability insurance or umbrella insurance that provides protection for your other assets if you were to be sued as the owner of the real estate.
Awesome. Thank you for that. That was super comprehensive. So said similarly, a little different, to simplify, we've got Katie Powell. Katie owns a house. That's great. But then we've got Katie Powell LLC, which owns the rental house. So really my liabilities can't necessarily be impacting one of the other entities, essentially. So thank you so much for that explanation, Megan. So Heather, Megan mentioned umbrella insurance. Can you just give me like a quick little taste of what umbrella insurance is?
Absolutely. And an umbrella policy is going to be excess liability. So it's liability over and above what your current policy provides. Now, depending on how that policy is covered, you can carry a limit up to what I would recommend $1 million. Oftentimes when you go up in your liability coverage on a property policy, that cost is, and I'll say minimal. I know that that's subjective to each, customer, but connect with your insurance agent when you're getting quotes and ask them to provide you a limit, to provide higher limits, and you'll often find that jump in prices is minimal. But again, that umbrella policy is excess coverage over and above that existing limit that you have. It can provide up to 10 million in certain cases. There's different types of umbrella policies that we provide coverage for. It can be, as Megan mentioned, depending on how you have that property, depending on how you own that property, will depend on how we insure that property. But we certainly have umbrella policies both on our personal side and commercial side, so that we can ensure that coverage is properly placed.
That makes sense. Thank you so much for that. I am seeing a few questions that are in the chat. We are going to get to some of these topics, so some of them I'm going to save for a little bit later. One question that is coming from the chat, though, can you easily transfer the property to an LLC? That's from Elizabeth. So this kind of sounds like your accidental landlord. Like, I purchased a house and then I lived in it, and then now I want to rent it out. Can you transfer a property into an LLC? And that's really for anyone who's comfortable answering.
Yeah, I can start, and then Jeff will probably backfill on this. Yes, you can transfer an interest from Megan's personal name to Megan's LLC. In certain states, that might be exempt from transfer taxes, or it might be subject to transfer taxes, depending on the rules where you are. But when you move it, the biggest thing is to find out, do you have a loan on that piece of real estate? And will transferring it from Megan individually to Megan's LLC trigger the mortgage or cause the loan to be called? And that's a decision based on that you really have to start with before you just move it yourself. And Jeff can kind of weigh in on how banks look at that. But that's the primary concern when you're moving things from your individual name to the LLC. You can do it, but you should pause if you've got a loan and consider whether that's going to cause a bigger issue or not.
And yeah, Megan's exactly right on that. The question is, will the bank call the note? And legally, you sign a document. If you have a mortgage, you sign a document stating that you cannot transfer the note from your name to an LLC without giving notice to the bank, and then the bank gets to determine what to do there. But most mortgages will state that that cannot be transferred, and if it is, the note can be called.
When you say note can be called, can you help us understand what that means?
Oh yeah, sorry. Thank you, Katie. What that means is the bank would send you notice saying that you are in default because you basically broke the contract of the mortgage, and that you now have to pay that off, and they give you we would give you like a 30 to 60 day timeline, and that can be different for each individual bank depending upon who you're working with. Now, there are times where the bank will work with you. So I just make sure the goal of all this is communication, connecting with your banker, having that discussion, asking or saying, hey, this is why I'm doing this. How do we make this work? And normally your banker will have good advice for you at that time.
And it may be okay for you to move it and to refi or redo your mortgage at that time, depending on the lending situation at that point versus when you got your loan. So having that as a trigger isn't always the worst thing, depending on timing, but you don't want to do it and get hit with a letter later, not knowing what you just did, right? It needs to be a decision that you make before you make the transfer to decide, is this the right approach or not? And if you can't, then maybe you consider getting more insurance during that time period and then moving it later, either when the loan is paid off or when interest rates go down or the lending environment is a little better where you are okay if you have to refi. So even if you can't move now, it doesn't mean you can't move ever.
Really good summary conversation. And I love this topic, because essentially here we're just talking about protection, right? How do we protect our assets? How do we protect ourselves? And I love that conversation. So thank you, everyone, for chiming in there on that one. So my next question, we're going to kind of shift gears a little bit. We're going to talk with Gerardo. So generally speaking, we're going to rewind. We're going to go back to 2020. Wild time to buy a house. People putting in offers over ask. Houses going off the market basically immediately. It was kind of rough for buyers, really exciting for sellers. Right. But now we fast forward to now, which seems like almost a complete 180. Again, depending on the market that you're in. So our audience, as you guys could see, is based throughout the country here. And with all of that being said, is the best time to buy a rental property in a buyer's market or in a seller's market, or does it really matter?
So thanks again, Katie. I would say, in my opinion, it doesn't really matter, as crazy as that might sound. I think once you make the commitment to become an investor, a real estate investor, then every market is going to have its own unique opportunities. A buyer's market is going to present, properties that will theoretically, hopefully, be at a lower price, with fair rents, and so that gives you a better return possibility. But if you're an investor that looks to trade properties and buy and sell, then the selling portion might be a negative during that time period. And vice versa, when you're looking at a seller's market, you're obtaining premium pricing on the properties that you're putting up for sale, but then you're looking at paying a premium. So I go back to a little bit of, identifying what's driving you to become an investor. What are you looking for? What are your major factors? And then just keeping an open mind throughout every single time period and making adjustments and so forth for the different types of markets. So knowing how to adjust for your buying parameters for a buyer's market versus for when it's a seller's market will be the key factors. But I don't And in my general opinion, as an investor and also as a realtor, each market is slightly irrelevant because they all carry their pluses and minuses with them at all times.
That's a really good point, and especially if someone's, taking this leap of faith and they're buying a rental property, they might start with one, but they might end up with 15, right? Like it's very dependent on their situation. So whenever you buy that one, it might be a buyer's market, and then you buy the next one, it's the seller's market. So it's a really good conversation of like, maybe it doesn't really matter. It's just really, again, dependent on your own goals. So thank you for that, Gerardo.
Yeah.
Okay, Jeff, my next question is for you. How much money do landlords need to put towards a down payment for a rental property?
Okay, good question. Like all questions, it depends, right? But what I would say is if you are buying it as a non-owner occupant, so what that means is if you are purchasing the property and not looking to live there, then the minimum is normally 20%. Now, if you are looking to buy it as an owner occupant, let's say a duplex, there are programs out there where you can get it with as low as 5% down or sometimes no money down. The concern though with that is that it's all based on what you're looking to purchase it as and for. Again, if you are buying the property and looking to live there, let's say a duplex, then there are real opportunities to get in with really low or really high leverage and low down payment. But again, you really have to sit down with your banker, your mortgage lender, and really have a discussion around how you're looking to acquire that property, how that property is beneficial to you, and what are your goals and aspirations around buying the property. Because there's all these different components that go into it. The idea around Megan's point around buying it under an LLC to limit your liability and limit your risk. But at the same point, if you're doing that, that kind of takes you out of the non-owner occupant or not out of the owner occupant side of things sometimes. But traditionally, if you just want to buy a property and you're buying as a non-owner occupant, it is a normal standard to see around 20% that you're going to have to put down.
Thank you for that, Jeff. Similar to what Heather mentioned earlier, it sounds like really all of the folks on this call, anyone in your profession should be included from the very beginning, right? Like, let's go at this as a team and really determine what's best for each individual. So it sounds like these folks are the right folks to really have in your corner, especially as you're beginning that process of purchasing your first rental property. So thank you, Jeff.
Can I say something really quick?
Yeah, of course.
I just going back to the part around everybody is instrumental at the onset of the idea of looking into this. Normally what happens is people go to the realtor, Gerardo, say, hey, I want to buy a property. Then what they do is, and they go look, and then they go get financing. And then the financing sometimes shifts you to where like, uh-oh, I'm not able to afford this area, but I'm able to afford this area. And all I would say is one of the biggest things is to try and have a sit down with all the individuals that are on this call, on this panel right now. And it doesn't, hopefully it doesn't cost you anything to sit down with any of these individuals, whether it be your lawyer, your realtor, or your banker, or your insurance agent. It's just you're putting the due diligence in initially to gain a real understanding of what you can actually afford and how you can move at a very efficient pace, because these markets are extremely competitive. So if you don't have that initial understanding of your own financial wherewithal or your financial portfolio, it really puts you at a disadvantage when you're trying to buy it. It makes it harder when you're working with your realtor to find a place, because you don't have everything ready to go or under wraps when you're looking to put an offer in on a property. I just wanted to throw that out there.
Yeah, no, that makes perfect sense. And thank you for that clarity. You're spot on, right? Like working together and getting everything up front. Great call out there, Jeff. I do see we've got some questions in the chat from Cassandra, Linda, Sunny. We are going to be getting to some of these questions later on. So just wanted to let you know, hang on a little bit. We'll definitely be getting to those and topics that we've got planned already. So my next question is for Heather. how is landlord insurance different than a homeowner's insurance policy?
Certainly, a homeowner's policy, it assumes that the owner of the property is residing in the home. And the coverage and endorsements that the homeowner's policy provides really meets those needs of the owner. So when you heard Megan talk about the different types of exposures and risks, those policies are built to meet the needs of whether you're a landlord or whether you're a homeowner. So for example, on a homeowner's policy, it's going to provide coverage for your personal belongings, maybe some collections you might have, jewelry. Those types of coverages you typically don't see on a landlord policy, as those items are owned by the tenant. So a tenant is going to make sure that they carry some sort of renter's insurance so that their belongings are covered. Both policies do provide coverage for liability. They're going to look within the policy language. They're going to look a little bit different though. That liability coverage on a homeowner's policy is going to extend off the property. So if you're on another person's property and something happens, that policy might provide you coverage. Now, on a landlord's policy, that liability stays within that property. Where that liability might provide coverage is if a tenant is injured on your property, you're found legally liable for that incident. Your coverage might pay for medical payments or defense costs. But understand though that each policy and each carrier might word the language within that policy slightly different. So it's always wise to consult a local agent.
Thank you for that. Very good education on the difference between homeowners and landlord. And I know later on we're going to talk a little bit more about renters insurance, and there were some questions in the chat. So we'll save the renters conversation for a little bit later. My next question is for Gerardo. So is it best to have an investment property that is move-in ready for a tenant or one that needs repairs?
So another great question. They both have their advantages and they both have their disadvantages. So this is going to go back again to the actual investor themselves. Case in point, the property that's move-in ready. So if a seller has, updated the units, remodeled the exterior, and gotten the property to be at its maximum potential, it usually means that they're achieving maximum rent. Which, when you're looking at investment properties, how are most of the values calculated? A lot of times is based on its actual, money generated investment return. So the benefit of having a property that's move-in ready, completely remodeled, completely done, is that there's minimal work that needs to be done, minimal remodeling, maintenance might be at a lower number, so it might be an easier property to maintain. But the trade-off on that is that you're probably going to be paying maximum dollars for that property, because that's what the seller's hoping to achieve. He is hoping to sell it for the maximum ability possible. When you're buying a property that's in disrepair, it's often you're looking at for the potential of it, so you're looking at what could be made of this property, what avenues could it be taken so that you could do some fantastic things and maybe generate excessive returns than what you initially planned on doing. So the negative on that is that it's going to take work, so it's one that you're going to purchase and then you're going to be immediately, be working on either the tenant base or the conditions of the units themselves, and then looking to, for the most part, take them to a level where you can then, rent to tenants that you prefer or generate the kind of income you prefer. So on one hand, you have ease of work, but you're paying maximum amount of money for. On the other hand, you're probably purchasing at a great value, but then you're going to be more hands-on to get it to a condition where you're going to be excited about.
Thank you for that. And that really goes back to some of the earlier conversations of just knowing your own comfort level with this. Knowing if you want to pick up the hammers and nails, or if you want to hire that out, or if you don't even want to do any of that. So really, it's just a matter of knowing your own comfort level. So thank you for that insight. Megan, my next question is for you. What should landlords consider when putting together a lease?
Yeah, I would say that leasing, especially for what I would call a casual landlord, somebody that's just getting into investment real estate, leasing is the place where we see the most do-it-yourself work done. people Google it, they pull something offline, or they get it from a buddy or a book that they buy at a store, if that still happens anymore, where they're picking up template leases and they're using those to save on costs of attorneys or other people to help them. And the danger of doing that is that leasing requirements, landlord-tenant leasing requirements, are very regulated, and they're regulated on multiple different levels. So they're regulated federally, statewide, countywide, and like local municipalities have their own rules on what you can and cannot say in a lease, what your notice periods have to be, etc. And the templates that you're pulling offline, then you don't really know if they comply with the requirements for your specific property. And so an example of that would be in a lot of places, including in Wisconsin, where we are right now, the applicable administrative code here has certain atomic bomb provisions that if your lease says certain things or contains certain provisions, that it will make the entire lease void, which is not good from an enforcement standpoint if you're trying to enforce or evict or use that lease to recover damages from a tenant. The last thing you want is for your lease to be held void because it had something in there that you didn't know was not okay. And those provisions can be things that you would expect to be okay if you don't know this area of the law, right? So an example might be allowing eviction for a crime committed on the premises. Those can be atomic bomb provisions that stating that can make the lease void, depending on how it's worded, depending on what the applicable rules and statutes are in your location. So it's really important for landlords to understand the landlord-tenant laws and rules of where their property is located, and to not necessarily pick up leases from place to place. So that's another thing. Local municipalities, for example, might have rules about smoke detectors that are different than other places, or grills on your patio, for example. So there are nuances, even if your properties are fairly close together in location, there are nuances potentially between places. So that's all to say that it's crucial for landlords to understand the landlord-tenant rules that apply in the place their property is located, and make sure that the leases that they're using comply with what the requirements are.
I had no idea. I like the term atomic bomb in the sense of like everything else is null and void because you had this one thing in the lease. I truly had no idea. So that's really great insight. Thank you for that, Megan.
And Katie, if I can add one more thing.
Yeah, of course.
I can't emphasize how critical having a solid lease is. It's the backbone of all of our communications with all of our residents. And so one of the things that our group has done is to really customize the leases in a manner that we want the buildings to be treated, maintained, and to be moved forward. And so that's our contract with all of the residents out there, and understanding and having a great contract that you can feel comfortable with, support with, is a major factor into the key success of the building over the long run. And so I agree with what Megan says. There's a lot of people who just take a random lease out there, and that's something that should put a lot of time and energy should be put into to making sure it's solid in place moving forward.
And those leases can have rules and regulations. To Gerardo's point, you may want to decide, what are we going to allow here? Pets or no pets, smoking or no smoking, grills or no grills. All of these things, are we going to allow people to use the basement or the attic or the parking? All of those things are set forth in your lease or attachments to your lease so that your tenants know how to use the property and what they can do. And landlords get to define what that looks like for their tenants, which is important if you're not going to be on site, right? You want them to know what's expected of them so that you can feel more confident not being there every day.
Love that. It really helps set expectations with the tenant of this is how this relationship is going to go, right? So
Right.
Thank you both for that insight. My next question is for Jeff, and it's actually from the chat from Cassandra. So if I purchased investment properties with an LLC, would I still be able to use the first time buyers programs for a personal purchase? So it sounds like this individual may not own any real estate right now, but if they purchase a investment property in an LLC, would they still be eligible for any first-time buyers credits if they were to purchase a personal home?
The quick answer would be no, but the longer answer would be, well, check with your banker, because there might be other opportunities for you to get other grants or other lending opportunities, depending upon certain type of loan products and programs that might be out there. But just on a traditional loan, if you wanted to, and again, this kind of goes into, if you want a 30-year fixed rate mortgage and you're going to the, they call it secondary market, but let's say if you're trying to get a standard loan that is backed by Fannie Mae or Freddie Mac to buy a property in an LLC, kind of takes you out of, you are no longer doing this as a personal property, you're doing it as a business. The LLC is a entity for businesses. So you're creating a business when you start an LLC, in a sense. So with that being said, you starting a business, it is no longer a personal property. So and first-time homebuyer programs are normally tied to a personal investment, a personal purchase, a personal property purchase. So short answer, you would not be able to use those first-time homebuyer programs, but there may be other programs out there that are looking for first-time individuals to get into investment property. Check with your banker.
Check with your banker. Love it. Thank you. Okay, Heather, we kind of teased the renter's insurance conversation a little bit earlier. I want to revisit that. Why should landlords have their tenants get renter's insurance?
Absolutely. You know, like I mentioned, that landlord policy does not cover the tenants personally. So a tenant carrying their own coverage is important. It's going to protect their belongings, and not just due to, you know, like a major catastrophe. Let's say somebody breaks into the property and there's minimal property damage to the home, but yet they've, you know, there were multiple items stolen out of the property. That policy is going to provide coverage for theft to tenants' belongings. In addition to that, the policy will also provide coverage for liability. So if the tenant has a guest over and the tenant has caused an accident or caused that guest you know, injuries while they were on the premises, there's liability coverage that also helps to protect the tenant that's in the property. Additionally, that policy can also provide coverage for loss of use. And what we mean by that is, let's say there is major water damage or a fire to the property where the home is deemed either unlivable or it's in repair, and you have to kind of pick up and go stay the night at a hotel or kind of pick up more long term. That policy could provide coverage for that loss of use and help pay that hotel expense or pay rent at a new place until you can get back into the property. So really that renter's policy is often a minimal cost to the renter. And again, I know that that's subjective, but that policy, it's really loaded with a lot of coverage and can really help save the tenant if they're ever in a situation where that property is either unlivable or again, they've got a situation like theft. But again, that policy, like I said, it's got a lot of coverage packed into that policy and can be really beneficial.
I just want to say, Katie, too, to draw that upstream about how that helps landlords is if a tenant has coverage for damage they've incurred in your property and they have a source of payment, coverage, reimbursement, whatever it is, they might not then go looking for a way to make the landlord liable for things that really were their issue or something that should have been covered. So from a landlord perspective, renters having renters insurance provides them with a different avenue of reimbursement besides always coming back to the landlord and saying somehow the landlord is responsible for the theft or the water damage or the loss or whatever it is.
Certainly. It's that first layer, that first layer of protection.
That's a really good call out. One question we have in the chat as a follow-up is third-party interest. So can a landlord require renters insurance? And then also, can the landlord be listed as like a third-party interest so that way they're notified if a insurance or if their tenant, cancels their insurance policy? Is that possible?
Yes, and yes. It's very very wise to require your tenants to carry renters insurance. As Megan and Gerardo talked about that lease, you can require that in your in your agreement with the tenant, and ensure that there is that that first layer of protection as you as the landlord. But in addition to that, we can also list a third party interest on a tenant's policy. A landlord can be listed on a tenant's policy, so you can be notified if that policy ever ever cancels for non-payment, or goes inactive for any reason.
Perfect. Thank you. And thank you, Jane, for that question. As a reminder, we do have the chats open and available for questions as they come in. We are running short on time here, but we will certainly try to get to any questions that you have. The last follow-up question I have for you, Heather, you mentioned a coverage called loss of use. So I know that's something that is available for renters if they're displaced from their home. But if that same thing happens, let's go with the fire example. So a fire occurs, and then the landlord, suddenly isn't getting that rental income. Is there any type of coverage that's available for the landlord if they're now missing out on some of that rental income?
Yes, there is, and there could be, depending on how your policy is structured or what types of endorsements you choose on your policy. But there is coverage for business income or loss of income on your landlord policy.
Perfect. Thank you. Thank you very much. Okay. My next question is for Gerardo. How far away from my investment property should I live? Should it be next door? Should it be 10 hours away? What's your personal preference, but then also what do you see some of your clients doing?
My personal preference is the property should be close or on your normal pathway, is I guess another way to describe it. I find the owners who have the best success are those who are able to stop by the property on a frequent basis, even if it's just once a month. The fact that they're able to put their eyes and on the property and their feet on the ground just makes a tremendous difference in terms of the upkeep. You're able to foresee problems happening sooner. You're able to monitor the residents a little bit better. And so that allows just for lower expenses, better returns, and then overall better growth in the property itself. So my recommendation for people is when they're buying properties is to put it on a pathway where it's convenient for them to stop by just on a normal basis. Often properties that are farther away are harder to deal with, harder to find resources for, harder to find repair people, because you're just not as well connected as those are the ones in your own community. So if for someone starting or for someone who's just kind of getting new into this business, keeping it within a reasonable distance, I think is always to their benefit.
Really good advice. And you mentioned the resources, right, of contractors. I mean, that's spot on.
Right.
You know your local contractors, but you may not know your contractor in Des Moines, Iowa, right? So that's a really, really good call. So thank you for mentioning that, Gerardo. My next question is for Jeff. So in 2023 and even now, where we saw interest rates really rise to similar rates as they were back in the early 2000s. So we can't predict the future on rates. I know your clients probably ask you all the time, but is it a good idea to buy a rental property even if the rental property may not cash flow because of those higher interest rates? Would love any thoughts that you have on that.
Yeah, this answer is I would say it's very hard for me to understand why you would buy an investment property that you have to pay into every month.
Sure.
That's not an investment property, I think. But again, it might be an investment property if, let's say, and again, I'm just going off of like examples. If this property were a property for your child that was going to college, like it might make sense to buy the property, because what you're basing your loss of income in is the idea that it is going towards a property, to Gerardo's point, that might appreciate in value over time. So then you have a different time horizon. And the idea of, if I paid for my daughter or my son or my child to go to college and, let's say, live in a dorm room that was $2,000 a month, and I could buy a property for my child to go, and it would be a 4 unit that she would only pay $1,000 or $500 a month. Well, then it probably behooves you to go that route, where it is an output of $500, but it's better than the $2,000 output of her, and maybe no chance of a return at the end from an appreciation standpoint. So again, it's looking at the idea, looking at what the investment is for, why you're doing it, and is it a property that your time horizon matches your investment strategy. So if you ask me the question simply of like, does it make sense to buy a property that doesn't make money for an investment, I would say no. But then I would probably ask you more questions as to why, what is the rationale behind it, what are your thoughts around what's your time horizon, so on and so forth. So, and then again, to ask the question or to tie back to interest rates, I think the hard part about it is the interest rate doesn't matter if the investment property makes sense for you at that time and you can get the numbers to work. And again, if the interest rates are higher now, but you're still buying the property for your daughter or son to go to college and live there for 4 or 5 years, and again, it's that whole, if not, then they would just be paying this, a higher amount per month. Well, then I would say, those are questions that need to be answered.
Thank you for that. Great. Okay. Next question for Megan. Megan, what can landlords consider when selecting a tenant?
Yeah, so the first thing is, generally speaking, landlords cannot discriminate in the rental of their units based on certain prohibited classes or categories. Race, national origin, religion, sex, disability, etc. Those are fair housing standards that are applicable to all landlords in what they're renting. What can they consider, however? They can consider the income of the tenant. So you're going to do some due diligence to figure out if there's a reasonable likelihood that the tenant can afford the property and make the rent payments. They can do a background check, so to understand the background of the tenant. They can look for a history of bankruptcy or other things, for example, to go into that analysis about whether they can afford and will be able to make payments. They can do credit histories to figure out if that will affect their ability to pay. And so those are some things that you can consider. Again, you need to look at local laws to figure out what's allowed in your area. Certain times you can collect fees or the costs associated with background checks or credit checks. In certain places, you can require that be paid by the possible tenant so that you don't incur a cost for looking into it. But those are regulated by your local laws as far as how much you can collect, how you collect it, how the cost gets paid, what happens if you deny them the rental application then. And so there's a lot you can consider. Knowing, again, the things you are not allowed to ask and not allowed to look into are important for landlords.
Really good advice. Thank you, Megan. So we really only have time for one final question, and I want to make sure we hit this question in the chat. I'm going to combine a question from Linda and Sunny. And this is really intended for Jeff, I believe. So when it comes to like showing income, so obviously someone might have a 1099, if they own their own business, or a W-2 if they are an employee somewhere. But does a property have to be like leased before were able to close on a loan, is that rental income considered in the overall income? And then also, is there any like impact for maybe short-term rentals like Airbnb?
Yep. To answer the question, income, you can use the income that the property is generating if you are purchasing property with a current renter in the unit. There are programs where if you do have a lease that is set for, let's say you're buying in June and the lease starts July, that can be used if it is fully signed and the contract is in the file to be used. And then the second part of your question again.
Yeah, really related to Airbnbs. So
Oh,
Airbnb
yeah, the
is a
short-term
little
rental,
more
right.
seasonality, but yeah, let's talk a little bit about how that might impact the income ratio.
There are programs that are out there, banks. Again, if you were working with like any bank where you have, I would say I'd see this on the community bank side more than I see it on a larger bank side, but I don't want to take that. I think larger banks probably have this program just the same. That if there is a track record of that property having short-term rental Airbnb income, we can use that as, again, as part of the underwriting process to see if you can afford, your ability to repay is met with the loan that you're looking to take out on the property. If it is new and you're going to embark on starting a short-term rental investment strategy with said property, there needs to be an understanding as to, have you done this before? Do you have that knowledge-based skill set that would allow us to feel confident in you being able to start that process or start that income revenue generating model? A lot of times that's a more difficult loan to underwrite. And so therefore, then what needs to happen is that needs to be really tied to your overall personal income. Can your income support the loan as it stands on its own? And then that income would be used as some type of compensating factor that we could use. But normally, if you haven't started the short-term rental process yet, then it leans to just you having to be able to afford the property and it's all of its debt, PITI, which people I think might be familiar with, principal, interest, taxes, and insurance on your own.
Can we talk about short-term rental from the legal perspective, just really quick to add on
Sure.
to that? Short-term rental is like a very hot thing, and it's very easy to post your location for short-term rental on Airbnb or VRBO or these other places. But you should really check with your local municipality for those, because in some places those are considered hotels, or short-term rentals have licensing requirements and inspection requirements similar to running a hotel. So I have clients with properties up north that they run for Airbnb, for example, in the summer when people want to go up north and enjoy the lakes, and they actually have to go through annual health inspections, building inspections, and license with their town or their county, which is something that casual landlords might not think through, because to them it's their personal house, but the way you're operating it is more similar to a hotel in ways.
Really good point. And thank you all for everything that you had just shared, but then also all of today's conversation. We had a lot of great engagement from the chat, and thank you for entertaining those questions and answering those. So with that being said, I do want to hand it back over to Andy to close us out.
Thank you so much, Katie. Just getting situated here. Yes, thank you all so much for taking the time out of your day to join us here. I know there was a handful of questions that came through about this event being recorded. I want to go ahead and drop another link in the chat to DreamBank's YouTube page. So the event will be uploaded here roughly about a week after the event. So keep an eye out for there in case you weren't able to tune in for the entirety or would like to share it with someone. And then I also want to go ahead and reference DreamBank's website. This is a great way just to stay connected to all of the wonderful events that we have in our pipeline, specifically honoring certain historically relevant and culturally relevant moments throughout the year, including Black History, Women's History coming up. So keep an eye out for that. With that being said, we will go ahead and cap it all there, and we will see you all next time. Take care.
Thank you.
Thank you.